Hello and welcome to Pro Trader Strategies Market Commentary for Friday, January the 15th. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I would talk about the economic data, the geopolitical environment, and how that comes in to impact the markets with some of my market analysis. I do the same thing in these daily market commentaries, but I go a little bit further, and I'm talking about my option strategies I'm implementing into my portfolio on any given daily basis based on the assumptions I come up with, peeling through the markets with my market analysis. For you folks, what I've done is I've, over 25 years, streamlined the process for you folks to follow along in order to find the optimal option strategy for any given assumption. Now, I'm not just saying you got a bullish assumption, you go out there and you buy calls. No, what we do is we look at the underlying, look at those internals, see what's happening in and around those options that we're looking to trade, and find the optimal option strategy. Now, that may seem a little bit vague, so you need to go over there to Pro Trader Strategies and check out my webinars where I go into each and every option strategy in detail, and we follow this roadmap right now where we come up with our directional assumption and then follow those specific guidelines in order to follow our path down to the right option strategy for your directional assumption. All right. Without further ado, let's get on with some economic data and see what's going on with the markets after how the markets are handling that economic data. We got some industrial production numbers across the pond. Great Britain industrial production coming in at negative 0.1%, expected to be a positive 0.5%, and last month's number was revised down to a 1.1% from 1.3%. Manufacturing production coming in lower than expected, just slightly, but still lower than expected. 0.7, expected to be 1%. And again, another revision to last month's number down from 1.7 to 1.6. So just only a slight revision there. French Consumer Price Index in line with expectations at 2%. Now we're moving back over here to the United States, and we got our retail sales number coming in at negative 0.7%, expected to be unchanged, and a revision to last month's number from negative 1.1% to down to negative 1.4%. So pretty big miss on retail sales. Not super surprising, as we saw and we talked about, if the people weren't getting those stimulus packages. I was even saying it looks like sales for the holiday season were going to come in a little bit less than expected. Plus, we were seeing those inventory numbers rise. That was giving us a little bit of a clue that, hey, we're not probably seeing the retail sales that were originally expected, and it's starting to show up here in the economic data. Core retail sales, that means we're stripping out the automobiles, came in at negative 1.4%, expected to be a negative 0.1%. And again, a revision to last month's number from negative 0.9% down to negative 1.3%. So pretty big miss on those. I think that's overwhelmingly what is weighing on the markets right now. We did get Empire State Manufacturing Index that came in at 3.5%, expected to be 5.7%. Another miss, so even more angst in the market, if you will. PPI, which is Producer Price Index, this isn't the ISM number, but it came in at 0.3%, expected to be 0.4%, so missing again there. That's silver lining today, folks, is coming in industrial production, coming in at 1.6%, expected to be 0.5%, and a revision to last month's number up by 0.1%. Capacity utilization ramping up to 74.5, expected to be 73.4. So nice, no revision there, but nice beat on the front line number there. Business inventories came in unchanged at 0.5%. That's what was expected there. University of Michigan consumer sentiment in line with expectations at 79.2, but starting to come off a little bit here from those 80s that we have been seeing. So this is like the lowest number since basically November, but still coming off a little bit again. University of Michigan inflation expectations 3%. Now that is up from the previous 2.3% was the original reading. They revised that up to 2.5%, but that's still an increase again this month to on those inflation expectations. A lot of that probably having to do with some of this crude oil moving higher. The inflation expectations is all of the prices of goods, right? Moving higher. And what we're seeing there is that those those prices that consumers are expected to pay for those goods and services for the last 12 or for the next 12 months is expected to rise. So keep your eyes on that. That's usually a sign of strength in the economy when we start seeing prices go up, and that is because people are buying. Now, what we really have to worry about is all of this printing of money that we have seen. Are we going to start seeing some inflation in a stagnant economy? All right, that is a major worry of all economies, is that you do not want to see inflation without that demand driving it. If it's just a weaker dollar, which the dollar has been strengthening, but I'm just saying if there's so many dollars out there, so much money in the system, that can drive inflation higher because every individual has extra money to spend. And that's what's happening with these stimulus checks, right? So they can drive prices higher despite the fact that the economy is stagnant. And that is kind of, well, that's called stagflation, is when the economy isn't moving or it's decelerating and we start to see inflation happen. That is a bad situation to be in. So we don't want to see that happening. All right. Crude oil coming off a little bit today after going up there and testing our Fibonacci at the 78 Fibonacci, which lines up with 54.19. You can see we came just inside of that. If I can land right on top of it, there we go. We got the high of 53.86 on the day. That is right there at 54, right? That's where we started seeing that value area high, our Fibonacci. We lost momentum there. We're starting to see the market come off. Probably because they're seeing the economic data isn't as good as what we were originally expecting. So market probably starting to come off because there is going to be that lack of demand. And listen, we already talked about it. Yes, there was a drawdown in crude oil, but it just went into different buckets. And if it just fills up different buckets, that means there is no demand for the product. Gold coming off, maybe a bit of the strengthening of the dollar here, but at the end of the day, we are really starting to look pretty weak here in gold futures. Now remember, I have on GLD for a long trade. I'm long some calls in there, and if we break below this low here, I've talked about it, that's where I'm going to pull the ripcord on it. So a settlement below 1817, that's where I'm going to be dissing this trade, and it's not looking too good right now. It's just looking very weak right now in the futures there. Bonds starting to make a bit of a move higher here, almost up a point on the day. We did find support in and around our double Fibonacci line here that we have at 167.17. We found support there. Looks like we're starting to make a move higher. I would like to see interest rates come off, especially if we're seeing a slowing economy. We don't want to see interest rates go up. We don't want to see inflation go up at the same time. You know, interest rates are going to want to go up if inflation's going up. It's because it's a signal. Inflation is a signal that the economy is starting to heat up, generally speaking, okay? And usually when we're seeing interest rates rise, that's to try and curb some of that spending, pull back on some inflation. But if inflation is happening because there's so many dollars out there in the system, then that is a different beast altogether. Like I mentioned before, I'm not going to beat that dead horse too much. All right, we've got the VIX moving a little bit higher. That's because we're seeing weakness pretty much across the board in all the equities, breaking below the 9-day simple moving average here in the Dow Jones Industrial Average at this point. Now, we haven't really had a real settlement. I mean, we did have a settlement here on the 4th of January, but remember, the 9-day moving average is a little bit of a lagger, and it didn't look like at that time that it settled below that line in the sand. We had actually settled above it. So we've been tracking right above that. Keep your eyes out for that today. A settlement below that line in the sand, that 9-day simple moving average, is really going to start making it look like we're going to want to roll back over, maybe down to this old high that we saw before the pandemic, or back down to the point of control here in equities. NASDAQ off by 100 points again, coming down below the same 9-day simple moving average. I mean, it's going to perform a little bit different because it's a different underlying. But the fact of the matter is it has gone below that. That's going to signal short-term weakness. Now, there is something to keep in mind is we do have this trend channel. That's an old trend channel from 2017, but it's still showing some support and resistance here along this trend. I'm kind of expecting if we settle below that 9-day simple moving average, we'll at least come down and test the 12,500 area in the NASDAQ. E-mini S&Ps, yes, off by 35 points. Again, same story. Below that 9-day simple moving average will show short-term weakness. Where could we expect to see this market start to correct to? Probably right back down here to 35.90, or let's just call it at least 3,600 should be retested. If we get that settlement below there, I think that we'll start to see all of the markets roll over just a little bit ahead of that. Especially if there's going to be talk about capital gains taxes, all right? That is going to be something that really makes investors a little bit nervous. They might try to take profits well ahead of that as well. So all of that being said, those things are making a move. And finally, overall markets are coming off, right? Well, of course, something like Coca-Cola has not been doing very well. We bought into this, or I bought into this as a synthetic long. On the 7th here, we got confirmation, which was nice, but in the next couple of days, the weakness just started filtering into this market. It broke below my point where I've talked about. Yesterday, I missed it because that was a really late day sell-off yesterday, and I missed that opportunity to get out, but I did get out today on this trade for my synthetic long in Coca-Cola. With that being said, if we start to see some support here around this area or start creating another candle where it looks like a hangman doji or something like that down here at the bottom of this move, which is starting to set up like that. Not this morning when I decided to get out. It was just breaking down and I pulled the ripcord on it. But it's not to say that I'm too proud to get back in. No, I would definitely get back in if I notice something like a bottoming pattern here, another confirmation of a bottom here. But we are getting very close to that point of control, and it might very well want to go down there and revisit that area. So I'm looking to hold off on my synthetic long at this point, and well, I covered my trade on this to get out of it for a loss, obviously. But if you guys remember, in this trade, Coca-Cola, I went into the March and I bought 50 calls and then sold the 50 puts in there. Now what that does is when I'm buying the 50 calls, they were right there at the money. It's a right around a 50 delta. That means for every dollar move higher, my premiums would increase by that 50 delta. So 50 cents would go in there. On the flip side, when I sell the 50 puts, if it were to move higher, that's a 50 delta also. So I should see my premiums decrease by that corresponding delta, which is a negative 50. So they would decrease. So that's how we create that synthetic long, is for every dollar move higher, my calls gain in value by 50 cents and my puts lose 50 cents in value. So it tracks what the underlying is doing. On the flip side, when it's doing what Coca-Cola is doing down here, I lose $1 for every dollar move down in the specific underlying, because my 50 delta calls that I'm long start making my calls that I'm long go down in value, and the call or the puts that I am short start going up in value, right? So I don't want that type of situation where I buy high, sell low in the calls, and I sell low in the puts and buy high. That is creating that exact movement that we would find in Coca-Cola for about a third the margin that it would cost for me to go out there and buy Coca-Cola. So for people that have smaller accounts, this is a great setup for some of you folks out there. So please, I have a webinar that I drill down on those details on synthetic longs, synthetic shorts, and when that is a good opportunity, or when there is the opportunity to add that kind of trade on. So without further ado, like I said, the March, bought the 50 calls, sold the 50 puts in there, and I paid a 19-cent debit. All right, that put me priced in right there around when we were trading right around $50.19 or so on the 7th there. Now, what has happened since then? We've gone down. So I've had to pay a higher debit. I sold it or I paid a debit of 19 cents, and I had to get out of this for a $1.55 debit, which is a loss all in all of right around a $1.74. So that was a losing trade on that end. I'm out of it though. We find a little bit of bottom and I can recapture some of this move to the upside. I will be happy to jump into it. Just like I did with Square, you guys. I mean, I missed on the first Square move. Second Square move, I took advantage of it. I'll do the same thing in Coca-Cola if I notice that we're getting that little bit of a bottom there. But that's all I've done so far today. I'm going to keep my eyes on different opportunities, but like I said, you know, this next month, basically starting Monday, we are full swing back into the earnings. So I want to keep some money on the sidelines for that type of event. And so I'm not going to probably add anything anytime soon unless there's something that really jumps out at me that I can't miss. All right. Please take a moment to go over our disclaimer. We are an educational company. I'm not trying to get you guys to do what I'm doing. Make sure you know your risks and what you are getting yourself into. All right. So have a great weekend. If you like what this kind of comment or commentary, you know, give me a thumbs up there. Give it a like. Also, comment down in the bottom what you want to see in these videos, or if you have any questions, comments, or anything else, I'll go back and forth with you until we're all clear concept. All right. So if you can't take that, take it easy.